Let us understand PE ratio. PE ratio or price to earning ratio looks at the relationship between price and earning. P ratio is also referred as earning multiplier or price multiplier. P ratio can be calculated by dividing price per share by earning per share. Other method to calculate P ratio is current market price divided by profit after tax. What P ratio tell us about is how much market is willing to pay for stocks earning. This ratio is used to find out the value of the company, whether it is overvalued or undervalued. Let us understand what a high PE means. High PE means higher expectation from a company is built which has shown higher growth perspective. Sometimes these stocks become overpriced and sometimes these are called growth stocks. As the market is willing to pay more as it shows positive growth performance. On the other hand, if the price by earning is low, this generally generates from lower expectation from a company with lower earning growth perspective. And it is called sometimes as a value stock, as investors look at these stocks as an opportunity. And these are sometimes also called as underpriced stocks. Let's talk about the limitation of using PE ratio, as it cannot be used when earning is negative. Secondly, it is not advised for valuing banking stocks. Instead of PE, price to book is a popular metric for valuing banking stocks. The third limitation it has is as it does not give a clear picture of company's performance, as earning can be inflated using leverage or accounting gimmicks. With this, we conclude this small episode on PE ratio. We'll be back with more such episode, so stay tuned.